5 months. That's all it took for Korea's benchmark index to more than double. Then in just 4 weeks, nearly a third vanished. This wasn't a meme stock, it wasn't crypto, so how did one of the world's hottest market become so violent? Government-approved casino, a real-life Squid Game, or is something much bigger happening underneath? Today, we're breaking down the question now hanging over this market. Is Korea trade really over? To understand Korea's recent volatility, you first have to understand how the market is built. As we all know by now, Korea is home to two of the biggest darlings of AI boom, Samsung Electronics and SK Hynix. Together, their weight in Kospi rose from 1/3 at the end of 2025 to more than half by May. That concentration wasn't built on hype alone. Earnings surged for sure. But it also left the entire market increasingly depend on just two companies. Even their proxy plays, SK Square, Samsung Life, and Samsung C&T joined the rally, turning the entire market into one giant Samsung Hynix trade. So when those two chips giant sneezed, the entire market catches a cold. Then came the Amplifier. In late May, Korea launched a single stock leverage ETFs tied to Samsung and SK Hynix. These products promise roughly twice the stock's daily gains or losses. The policy logic was straightforward. Korean investors were already buying 2x products in Hong Kong and as much as 3x leverage in London. Domestic versions were meant to bring that trading and capital behind it back home. But here's the catch. To maintain 2x exposure, these funds rebalance every single day, buying more after gains and cutting exposure after losses. In market terms, it created short gamma-like flows. And as the funds grew, so did those trades. The ETFs were supposed to follow the stocks, but tail was starting to wag the dog. Because the market was built on two giant chips, that feedback loop could drag the entire index with them. But a 2x button means nothing unless people are eager to press it. Then one might ask, why were Korean investors so ready to press it? Are Koreans simply hungrier for risk than everyone else? Is it Korean DNA? Not biological DNA, perhaps, but economic DNA shaped by a wealth ladder that increasingly feels out of reach. For generations, the Korean traditional path to wealth in Korea ran through real estate. Over the past decade, the average transaction price of a Seoul apartment rose by roughly 143%. For those who already owned property, it was a powerful engine of wealth. For those who didn't, the ladder kept moving higher. Today, the average Seoul apartment costs more than 1 billion won, $670,000 approximately. That's 18 and a half years of salary before taxes, before living expenses. So for many young Koreans, the stock market is not necessarily the final destination. The housing market is. The stocks are the vehicle they hope will get them there. It is a way to build the seed money for a home prices before it even moves further out of reach. And when the destination feels urgent, that is where the leverage button comes in. Bigger returns and compressed time. But the same structure that powered the rally left the market dangerously exposed on the way down. By then, retail cash buffers had already thinned. Investor deposits, the cash sitting in brokerage accounts and ready to be deployed, had fallen from nearly 140 trillion won at their peak to about 100 trillion won. Foreign investors had been trimming Korean stocks throughout the whole year, not necessarily because they lost faith, but because the rally itself had pushed their exposure above the benchmark and risk limits. Retail investors absorbed that selling for months, but when the next wave came, much of their buying power was already gone. So where does the frenzy end? Once the tail started wagging the dog, Korean regulators stepped in. New listings and advertisings were halted immediately, and regulators have now brought forward the next step. Starting July 31st, investors will need 30 million won in cash, not stocks, ETFs, or bonds, to buy the single stock leverage products. A 20-unit minimum trade is also expected by November. The idea is not to eliminate the leverage, but to stop leverage products from becoming powerful enough to distort the market and the stock beneath them. Opinions are divided. Supporters say the measures could cool the speculation and reduce volatility. Critics argue they do not go far enough, and regulations has not eliminated the appetite for leverage. Some of it has simply moved overseas. After the rules were announced, SOXL, a 3x US semiconductor ETF, rose to number 1 on Korean investors' overseas net buying list. TQQQ, which triples the daily move on Nasdaq 100, climbed to number 2. Even so, the frenzy at home appears to be cooling. Trading activity has eased from its peak, and the earlier cash requirement is designed to reinforce that trend. The broader market is also showing signs of stabilization. After the correction brought Samsung and SK Hynix index weight back down, some of the foreign rebalancing pressure began to fade. Foreign buying has also begun to return, helping to ease some of the pressure, even if the recovery remains uneven. For now, at least, most of the violent phase of the sell-off may be behind us. Today, we explored both sides of the Korean market, the heat that powered its extraordinary rise and the risk that made the fall just as violent. The sell-off may be easing, but there's no single answer to whether the Korea trade is over. One thing, however, is clear. This market is not telling us whether it is finished. It's showing us exactly what it is: concentrated, leveraged, and impossible to ignore. And with Korea now at the center of the global AI trade, what happens in Seoul can ripple all the way to Wall Street. So, what do you think? Is Korea trade really over? Let us know what you think in the comments. Hit like, subscribe, and stay tuned.